All right, everybody, welcome back to Alternative Finance. My name is Alex, and we are on day 5 of our Investing 101 series. And today we're talking about risk. But before we get started, if you are into this type of content, if you are liking what you are seeing here and you want to be in for all the things we're doing here, not only with this series, but everything else we got going on, please subscribe to the channel. Tell your friends so we can get this all out there. Like the video if you do like it. And without further ado, let's jump in and talk about today's topic, which is what is risk? As always, we are going to start with a definition. What is risk? Very basically, risk refers to the possibility of experiencing a negative outcome or loss. Now, risk is going to have a couple of key aspects. So what are those? Key aspect number 1 is going to be probability. So how likely is it that this risk, whatever might happen, how likely is it that it's going to happen, right? What's the probability of it? Number 2 is the magnitude. So if it does happen, how bad would it be, right? Two different things. Probability, how likely. Number 2, how bad would it be if it happened? And number 3 is going to be that level of uncertainty. So how difficult is it for me to predict which way this is going to go, right? These are 3 very crucial aspects of risk that are always going to come into play when you're gauging these different types of risk. All right, everybody, real quick, we're going crib mode because I got something serious to talk to you guys about, right? So this video that we're going to talk about here today is mainly about the different types of investment risk that you might come across along your journey. I want to take a moment to talk about what I consider to be the biggest risk potentially that you might face. And if you are facing this risk, I want to take a moment to go full camera mode here, talk at you one-on-one, and express this to you. So that risk that I'm talking about, and I kind of leaned into it a little bit yesterday, is the risk of not meeting your financial goals. Now, I mentioned a couple scenarios yesterday, and I want to give you a very, very specific one and a little more detail really quickly here to let you know what I'm talking about. So let me give you the example of a retiree. I all the time work with retirees who tell me I do not want to take any risk because I am retiring. And what they mean by that is I want to be only in fixed income investments. So bonds, CDs, bank products, things like that that do not bear any risk because I'm at the end of my road and I don't have the time to be risky, right? If you have the ability to do that and meet your financial goals, absolutely, that makes 100% sense. But I have encountered many times where to go fully conservative, the biggest risk that the retiree faces is running out of money. And therefore, that leaves us in a place where we have to take some sort of investment risk in order to avoid the risk of not meeting our goals. Because in the variables that we just talked about, the risk that I'm talking about when it comes to probability, it can almost be a certainty in some situations that you will not meet your goal. And in order to change that, we have to bear some of these investment risks in order to reduce the probability of that risk of not meeting our goals actually coming to fruition. Because the magnitude would be catastrophic, the probability is almost a certainty, and therefore we have to take some types of risk in order to achieve and in order to avoid the main risk that we're facing. So that was a long-winded way of saying it. I appreciate you sticking with me. Now, without further ado, we're going to get back into the video and talk about investment risk. So what is investment risk? Investment risk in the context of finance and investing is the uncertainty about the return on an investment and the potential for losing some, if not all, of the money invested, right? So how likely is it my stock's going to go up and how likely is it it's going to go down, right? That is your investment risk. So what are the main types of investment risk? We're going to walk through a few of them here and kind of blast through them. Number 1 is the market risk, right? So that's the possibility of experiencing losses due to fluctuations in the overall financial markets. This one's very difficult to avoid, even if you properly diversify, because if the whole market is doing something, it's very unlikely that your portfolio is going to be spared from that, right? So that's market risk. It's pretty hard to avoid without really doing some things like hedging or things like that. Number 2 is going to be credit risk. So this is really, really significant in things like bonds, right? And what credit risk is how likely is it that the person who I lent my money to is not going to be able to pay me back, right? So again, very, very common in bonds. Definitely a risk we want to watch out for. Number 3, liquidity risk. So that is the difficulty of converting an asset into cash without significantly impacting its value. So what do I mean by that? Let's look at 2 examples. A stock. I click a button, like I mentioned in my stock video the other day. If you didn't watch it, go back and take a look at it. But when I sell a stock, I click a button, it sells, I get my money in my hands to be spent within a couple days max. Versus something like a house, right? Let's look at a house. If I want to sell a house, I might be able to sell it very quickly like that. But more than likely, if I'm trying to get the fair market value, especially if we're in an area where there might be more of like a buyer's market versus a seller's market, and depending on certain things, it may be very difficult to sell that house, let alone sell it quickly and be able to realize all of the value that is there, right? So how quickly can I sell it and get what it's worth? That is liquidity. Next up, inflation risk. So that is the risk that things will become more expensive over time than my money is growing, right? How fast my money is growing. So that's the risk where rising prices reduce my purchasing power. So in the event I invest in something like a CD, if it's a 3-year CD and I'm earning 3%, but inflation's been 5%, by the time I get my money back with my CD and all my 3% I earned over that time, things are going to be way more expensive than they were when I put that money in. And it's not going to have paid off at the rate that things are increasing in price. That's inflation risk. Kind of going hand in hand with that is reinvestment risk, right? So the risk of reinvesting earnings or matured investments at lower rates, especially in declining interest rate environment. So when I get my money back, what if rates have gone down? Like forget inflation. What if now I get my money back, I invest in a CD, same example, it's at 3% or whatever. I get my money back and now rates are at 2% or 1%, but I needed that 3% income. That would be reinvestment risk. Next up, concentration risk. And people are probably familiar with this one, but that is the risk of overexposure to a particular sector or a company or an asset type, and that increases your vulnerability to losses if something should happen to that sector or that company. So in chances like something like oil prices, something crazy happening with oil prices, that would affect the entire sector of energy, right? So if you were really heavy in energy, that would be where you face concentration risk, right? Something like that. Next up is business risk. So this is now getting very specific to the company or entity that you are invested in. And this includes risks from things like poor management, competition butting in, industry-specific issues. So this would be more so like my company or my entity if I invested in a bond and it was like the city of whatever, that city really was struggling more so than the rest of the other cities out there, that would be business specific risk, right? And that's where we can definitely diversify and prevent some of this type of stuff. So last but not least, I have currency risk on the list. So that is the risk of losses due to fluctuations in foreign exchange rates, right? So that would affect your international investments. What I mean by that is here, we'll use the US as an example. Here in the US, you can invest in companies in the stock market that are from other countries. So whether that be China, Brazil, the countries in Europe, you name it, you can probably invest in companies that are domiciled there. And the way that that works is those companies operate in their own currency. And then for your investment purposes, it is converted back into the US dollar. Now, if the US dollar is weakening, right, or strengthening, it's definitely going to have an effect on that conversion. And just that currency changing and that the natural flow of that currency will actually have an effect on the stock price. So that could help or hurt your stock, in addition to the fact that obviously has all of its underlying business related things going on beneath the surface that would normally affect any other company. So I'm understanding risk, I think. I'm understanding all the different types of risk that could be out there. And now I want to get a grip for how do I determine what my comfort level is with risk? How do I assess my risk tolerance? And we're going to talk a little bit about that here today. We will again do a more detailed video at another time, but we'll talk about a little bit here and let's look at it. So first and foremost, if you want to start assessing what is my comfort level with these investments and my risk, where should I be at? First and foremost, evaluate your finances. So number one, do you have a stable income? Do you have an emergency fund? Are you carrying a lot of bad debt or any bad debt that needs to be worked down before you can start addressing things? Can you afford to endure losses without disrupting essential expenses? So can I put money in something and not have to worry about it because I have enough money over here to take care of everything else? Or am I going to need to take that money back out? These are things we want to first and foremost address and think about. Next up, you want to define your investment goal. So am I investing for the long term here? What goal is this for? Or is this more of a short-term goal? Am I going to try to buy a house in a couple of years or something of that nature? Number two, am I focused on capital preservation or maximizing returns? Do I want this to grow or not decline, right? Choose, pick one, and that will definitely help you identify the appropriate level of risk to take. Number three, consider your time horizon. So shorter time frames typically are going to require lower risk investments, right? Because you don't have time for that money to recover should something happen to it. So you want to take less risk if your goal is really close on the timeline. Number two, longer horizons allow for more exposure to higher risk assets. Kind of the flip side of that, right? If I am looking way, way off into the future, I can stand and let that investment kind of wobble a little bit in the meantime because my time horizon's way off down in the future and I can really just let that work. Number four, this is probably the most difficult part of all of it, is gauging your emotional comfort with volatility, right? This is where you need to be honest with yourself. Would market declines cause you to worry, or would you be excited about the potential to buy stuff? What kind of person are you? Is this going to keep you up at night? Are you going to lose sleep over this? If you are starting out more conservative and slowly, gradually working your way to it at a pace you feel comfortable with is incredibly important, because we do not want investing to scar you to a point where you did not know what you were getting into. You bit off more than you could chew, and now you're not going to do it anymore because you were hurt so badly by that type of scenario. So what kind of person are you? And are you comfortable holding through downturns, or would you sell quickly? Because if that's going to be the case, again, we want to make sure we're focusing on things that are going to be appropriate with your comfort level, so you're not inclined to abandon your investment plan at the first signs of wobble. Finally, you can take a risk questionnaire. This will allow you to kind of get a score, so to speak, of what your risk is. Again, this only does you any good if you are honest with yourself. So don't worry about what your friends would think about your answers. You don't need to show them this stuff. Be honest. Take the questionnaire. It might be able to give you at least a starting point of where to look and where to start working from. And should you choose to work with a financial professional, kind of give you a basis to kind of let them know, this is where I stood, this is where I'm at, and kind of give them a way to guide you more effectively. So if you are looking for more information about this and you want to get to work on doing some of this stuff for yourself, please consult a financial professional before you get to work on it. And if you have any questions, as always, feel free to let me know. If you like this content, like the video, leave a comment, subscribe to the channel. We got a lot more to come. And until next time, you guys, I'm Alex, and this is Finance AF.